Alright guys, settle in because what I'm about to walk you through is something most XRP holders haven't even bothered to notice. And honestly, that's exactly why they keep getting blindsided. For months, everyone's been screaming about the charts, the candles, the death of momentum. But nobody's actually zooming out long enough to understand what's really happening underneath the surface. And that's why this matters. If you hold XRP, whether it's 50, 500, or 50,000, this perspective might genuinely change the way you view the entire market. Let's start with the obvious. Ever since XRP peaked back in July, we've been grinding down. Not crashing, not imploding, no grinding. A slow, painful bleed that punishes impatience and rewards people with discipline. We hit that 365 high, and since then the market dragged all the way into the $180 range, even spiking down to that brief 120 wick that everyone pretended was some major collapse. It wasn't. It was a liquidity grab, the classic flush, and we snapped right out of it. But here's the part people refuse to admit because it hurts their ego. This could actually mean XRP entered a quiet bear phase months ago. Not a collapse, not a failure, a normal cyclical retrace, and the same kind every major bull market has before it launches the real move. And if you understand crypto history, this should light a fire under you. The last 3 crypto bear cycles, the actual cyclical ones, lasted between 6 to 12 months, nearly every single time. Not 18 months, not 3 years, 6 to 12. And we're already deep into that window. That means if this is indeed a micro bear within a macro bull, the clock is already ticking and the opportunity window is shrinking fast. So while most people are complaining, panicking, or waiting for the perfect bottom, the smart ones, the disciplined ones, are recognizing that this is the exact kind of structure that always precedes a massive reversal. The kind of setup that destroys impatient retail traders and hands their positions to the people who understand how these cycles really work. And trust me, if you're watching this right now, you're already way ahead of that 90% who only show up when green candles return. Now, let's get into the real meat of this breakdown. The pattern almost nobody talks about. Yet, it has been repeating with ridiculous precision for months. Forget the noise. Forget the emotional tweets. Forget the YouTube thumbnails predicting either $10 overnight or a catastrophic collapse. I want you to lock in on something factual, observable, and backed by actual price action. The 4 red candle setup that has quietly delivered some of the most reliable opportunities in this entire XRP cycle. I'm not exaggerating when I say this. If someone had simply accumulated XRP every time the chart printed 4 consecutive red daily candles, they would be outperforming 95% of crypto holders right now. This isn't hindsight bias. This is something you can scroll back and verify on a daily chart yourself. Look at what happened in early August. XRP printed 4 straight red candles. Nothing spectacular, nothing dramatic, just a slow bleed that looked like typical emotional exhaustion. Anyone who bought that 4th candle got in around the 274 range. And what happened right after? Not even 5 days later, XRP ripped back to $3.33. That's not normal sideways noise. That's a clean structured liquidity sweep, followed by aggressive accumulation and a textbook rebound. Then, it happened again. 4 red candles. XRP dropped into the 311 zone, and again within days it pushed back to the 300s and 30s. This is not coincidence. It's not mere chart luck. It is the exact playbook institutions rely on. Create fear, force retail to panic, sell, soak up liquidity at a discount, reverse the chart once positions are filled. Retail reacts emotionally. Institutions react mathematically, and XRP's price structure has been exposing that difference in real time. But here's the craziest part. This pattern didn't stop in the summer. It happened again just recently. 4 red candles ending on November 22nd, followed immediately by a clean rebound toward the 2.28 zone. Same concept, same mechanism, same result. Now, if you step back, this isn't just a pattern, it's a psychological trap. Institutions know retail investors crack after 3 or 4 days of bleeding candles. They know fear overtakes logic. They know people convince themselves, yo, maybe I should get out now and buy back lower. And that's the exact thought that liquidates retail positions and hands their supply directly to the players who understand timing and liquidity dynamics. You have to understand something harsh but true. Most people claiming to be long-term holders are nothing more than emotional short-term traders pretending to be disciplined. The second they see 4 red candles, they panic. They sell. They exit positions they swore they'd hold for years. And institutions take those tokens 1 red candle at a time. That's why this pattern hits so hard, because it reveals the uncomfortable truth about how this market works. XRP doesn't dump because it's weak. It dumps because it's being harvested for liquidity by entities with more capital, more patience, and far more experience than the average retail trader. And once those entities finish collecting, they push the chart right back up. Now, I'm not telling you to blindly buy 4 red candles without thinking. I'm telling you to recognize why this pattern exists. Recognize what it exposes. Recognize that the market is not random, it's engineered. The 4-day bleed is not a coincidence, it's a mechanism. And the rally afterward is not luck, it's a reflection of demand returning once the supply flush is complete. And this brings us to something even more important, the broader market context. Because XRP isn't operating in a vacuum. Bitcoin is still the driver of overall sentiment, liquidity, and macro momentum. And if you really want to understand what comes next, you need to understand why Bitcoin's behavior right now is setting the stage for XRP's next big move. Let's get something straight. XRP does not move in isolation. You can love XRP, believe in the tech, understand the utility, and still accept one undeniable fact. Bitcoin sets the tempo for the entire crypto market. That's not opinion, it's structural reality. And right now, Bitcoin is sitting at one of the most important levels it has touched in years. The line you should be obsessing over is $95,000, the 100-week EMA. If Bitcoin holds above this level for several weeks, not hours, not days, but weeks, it signals something very simple. The bull market is preparing for its next leg. Not hype, nodium. A structural confirmation from the strongest asset in the ecosystem. Bitcoin recently pushed back above $91,000 after a deeper retracement. And if it maintains strength, it gives XRP the green light to break out of its mid-cycle consolidation. This is why you can't ignore the macro picture. And the macro picture doesn't stop at Bitcoin. Something far weirder, and honestly more important, is happening in the housing market right now. Most people glance over it, shrug, and move on. That's a mistake, because what's happening in housing right now hasn't happened often in history, and every time it did, it signaled a major shift in the global financial landscape. For the last 12 months, new single-family homes in the U.S. have been selling for less than existing single-family homes. Let that sink in. This is not normal. It has only happened a handful of times. Right before the 2007 to 2009 financial crisis, during Japan's lost decade, during the UK recession of the early 1990s. When new homes sell cheaper than older homes, it suggests one thing. Developers are under intense pressure. They don't have the luxury of waiting. They have loans, deadlines, debt servicing costs, and escalating interest burdens. When they need liquidity fast, they slash prices. This is a symptom of something deeper. Capital stress across the system. Now, the good news is, the U.S. housing market today is structurally different from the 2008 era. People aren't over-leveraged to the same degree, and mortgage standards are much tighter. But the underlying issue is the same. Liquidity is drying up. And guess what happens when liquidity dries up long enough? The government steps in, the central banks pivot, quantitative tightening ends, quantitative easing begins, money printing returns, institutions get access to cheaper capital, risk assets, including crypto, surge. There's a direct cause and effect relationship here, and ignoring it is reckless. XRP doesn't pump because of vibes. It pumps when liquidity floods into the system. And make no mistake, the pressure building across markets right now almost guarantees that liquidity printing is coming back sooner rather than later. When QE starts, the cost of debt drops, banks loosen, developers breathe, risk appetite returns. And historically, the asset class that benefits the most in the early stages of QE isn't housing, isn't bonds, isn't equities, it's crypto. People flee decaying fiat. They chase hard-capped assets. They search for asymmetric upside. XRP thrives in liquidity expansions because it's designed for fast settlement, rapid movement of value, and large-scale flows. When money starts moving again, XRP reacts violently and not in the slow grind we've seen the last few months. But here's the real kicker. You don't need the macro conditions to be perfect to capitalize right now. Why? Because the 4 red candle pattern is independent of macro cycles. Institutions don't stop harvesting liquidity just because the housing market is strange. They don't stop forcing red candles just because rate cuts are pending. They don't stop flushing retail positions simply because QE is near. This is why pattern recognition matters. Macro tells you the direction. Micro tells you the timing. Together, they create a window of opportunity almost nobody notices while they're panicking, whining, or waiting for certainty. Here's the truth. Retail always waits for confirmation. Institutions buy uncertainty. That's why institutions win. Now that you understand the macro pressure building under the surface, the housing distortions, the looming return of quantitative easing, and Bitcoin's pivotal technical structure, let's tie this into the real engine driving XRPs. Next phase, liquidity behavior. Because the truth is brutally simple. Markets don't move on sentiment, they move on liquidity. And right now, liquidity conditions are setting up in a way that historically precedes violent upside moves across crypto. When liquidity dries up, retail panic sells, developers charge home prices, and institutions sit back and wait. But when liquidity returns, and it always does, the players with dry powder move first, fastest, and with the largest size. And this is precisely where XRP becomes a strategic play rather than a speculative one. Here's what most people don't understand. Liquidity expansions don't happen slowly. They don't creep in. They hit like a wave. Rate cuts don't trickle. They pivot. QE doesn't ease back in gradually. It floods. And once that flood hits, assets with suppressed valuations and clear structural demand almost always explode first. This is where XRP's positioning becomes impossible to ignore. Because unlike most cryptocurrencies that rely on hype, narratives, or temporary catalysts, XRP is fundamentally tied to value transfer. It reacts to liquidity in a way that's far more direct than speculative tokens. That's why historically, XRP's biggest moves happen during macro liquidity expansions, not during isolated hype cycles. But here's the twist. You don't even need QE to begin yet to identify opportunity, because while everyone is staring at interest rates, institutions are quietly laying their groundwork. The pattern with the 4 consecutive red candles is a perfect example of how institutional positioning works ahead of time. Think about it logically. If institutions know liquidity is coming back, do you think they wait until QE begins to accumulate? Hell no. They accumulate before the pivot. When prices are suppressed, retail is demoralized, and fear dominates the narrative. Combine that with what we're seeing on the charts. 4 red candles, immediate recovery, deep liquidity sweeps, instant reversals, sharp dips absorbed aggressively. These aren't random fluctuations. They are footprints of accumulation. Here's the brutal truth most retail traders avoid. Institutions need liquidity to buy, and retail panic is the cheapest source of that liquidity. When markets show weakness, institutions don't panic, they prepare. When you see 4 red candles, you see danger, they see opportunity. And they follow a principle that has worked for decades. Accumulate when fear is elevated, not when confidence returns. But institutions aren't the only ones leaving clues. Developers struggling to sell new homes, banks preparing for rate cuts, policymakers positioning ahead of QE. These are macro indicators that historically precede strong crypto cycles. When the system is a liquid, crypto stalls. When the system is flooded with cash, crypto erupts, and we're heading exactly into that window. This is why the idea of waiting for a lower price is such a grave mistake for most investors. Markets never reward hesitation. They reward preparation. They reward pattern recognition. They reward people who understand that the best opportunities rarely feel comfortable in the moment. And let's be brutally honest, most retail investors do the same thing every cycle. They panic sell near the bottom. They FOMO near the top. They wait for certainty that never comes. They believe in long-term holding until the market tests their emotions, then they fold. And that is exactly why institutions win, because they accumulate when retail is scared and they distribute when retail is euphoric. This is why the 4 red candle setup matters so much right now. It's not just a pattern, it's a reflection of who controls the liquidity flow. It's a reflection of the psychological manipulation built into every market cycle. And it's a reflection of why certain traders consistently win while others consistently lose. Now let's take all of this, the macro setting, the liquidity cycles, the institutional behavior, and bring it into the final phase of this breakdown. How to actually approach this strategically without falling into the traps that wipe out 95% of retail. Now that we've covered the macro pressure, the Bitcoin structure, the housing signals, the liquidity cycles, and the institutional playbook behind XRP's recent behavior, we need to land this in a way that's actually useful, something you can think through strategically without falling into the same traps that erase retail portfolios every single cycle. Here's the uncomfortable truth. Most people watching this will still repeat the same behavior that destroys 90% of crypto investors, not because they're dumb, not because they lack information, but because they lack emotional discipline. And emotional discipline is the real difference maker in a market designed to exploit impatience. Look at how this cycle has played out so far. Every time XRP prints 4 red candles, retail gets anxious. They think the trend is breaking. They think more downside is guaranteed. They assume institutions see the same red candles they see, and when in reality, institutions see blood in the water and they want more of it. This is why the 4 candle pattern is so powerful. It doesn't just reveal price action. It exposes the psychological warfare built into crypto, because institutions know the exact point where retail breaks emotionally. 3 or 4 consecutive days of red candles. They know that is the moment when doubt peaks, when fear takes over, when people are most vulnerable to selling low. And once retail finally gives up their positions, the chart rips higher every single time. This is why most investors never get ahead. They respond to emotion instead of mechanism. They buy strength, sell weakness, and call it strategy. But that's not strategy. That's human nature getting exploited. If you want to survive this market, especially with an asset like XRP, which is brutally precise in how it hunts liquidity, you need to develop the ability to separate noise from signal. And right now, the signals are pointing toward one thing: opportunity disguised as frustration. Let's look at the reality. XRP has been quietly consolidating for months. Institutions are harvesting liquidity on predictable 4-day cycles. Bitcoin is hovering near a historically important support structure. The housing market is screaming that liquidity is drying up. Central banks are preparing for the next pivot toward easing. Liquidity injections historically ignite crypto cycles. XRP performs best in liquidity expansions, not contractions. The combination of these factors creates a perfect storm, the kind retail always misses because they're too focused on daily candles and short-term fear. But here's the ultimate point. You don't need to be perfect. You don't need to time the bottom. You don't need to trade every pattern. All you need is consistency and awareness. If you've been paying attention to the 4 red candle cycles, you already have a better lens than 99% of new investors. If you understand that macro liquidity cycles drive XRP more than random news articles, you're already in the top tier of observers. And if you've seen how quickly XRP reverses once institutional accumulation is complete, then you also understand why sitting on the sidelines is the most dangerous position of all. Because here's the part nobody wants to hear. Most people don't get left behind because they can't afford XRP. They get left behind because they hesitate. They convince themselves they'll buy lower. They wait for the perfect entry that never comes. And by the time they realize what's happening, XRP is already levels above psychological reach. That's the trap, not the price, not the volatility, the hesitation. This market rewards people who move with conviction based on data, not emotion. So, as we move into the next phase of this cycle, remember this. Every dip looks terrifying in the moment, every breakout looks obvious afterward, and every cycle ends with the same story. The discipline rise, the emotional fall. You get to choose which side of that equation you want to be on. Thanks for sticking through this breakdown. As always, this is not financial advice. Do your own research before making any investment decisions. But if you've been paying attention, you already know the window doesn't stay open forever. Let's stay sharp, stay informed, and stay ahead of the